It probably has never been harder for you to buy a home as it is right now. If you're in the market to buy a home, this housing market is definitely not for the faint of heart. Mortgage rates are creeping up above 7% for the second time in the last 12 months, and there's still a historically low number of homes for sale. So despite the fact that mortgage payments are going up and up, the prices of homes seem to not be coming down at all. Just to give you an idea of how rough it is in the market right now, one of my buyers was looking for a home and they found one priced at $750,000. And after competing with over 43 other home buyers and offering well above $80,000 above the ask price, they were still beat out by another $10,000 by a cash buyer of all things. And unfortunately, that is an all too common story in this housing market right now. Despite the fact that the spring housing rush is definitely in effect and there's a lot of buyer demand, there still isn't enough supply in the market to satisfy that, and the inventory that we were expecting to come during the spring still hasn't quite thought out. But despite all of that, the question you're asking yourself right now is, should I still buy a home in 2023? And so today in this video, you're going to learn the 3 things that are driving this unique housing market in 2023, and I'll let you know whether or not I think you should be buying a home at all this year. Now, if you're new to the channel, my name's Kaiton. I'm a loan officer from San Diego, California, and on this channel, I help people just like you learn how to buy their first home and make great financial decisions. Now, if you learned something new during this video, hit that like button. And if you have a question, leave a comment. Whatever you decide to do, it definitely helps the algorithm and helps me reach more potential home buyers. But enough about that, let's talk about making a great financial decision in this market today. Now, the biggest thing that you need to understand about this market, and what's been driving it really over the last 12 months, has been interest rates. Now, while mortgage interest rates have more or less tracked the direction of the federal funds rate, which has been going up steadily over the last few months, one of the most important things you need to realize is those two aren't the exact same thing. That being said, as of today, we are starting to see interest rates above 7% for the second time in the last 12 months. As you can imagine, rates in the 7s are not really pretty, especially considering that just 2 years ago, you could get a mortgage and get a rate around 3% or lower. So what does this mean for affordability when it comes to the housing market? As an example, when rates were as low as 5% even, you could buy a $700,000 home and your total monthly payment would be about $4,500 a month. However, now with rates above 7%, that same $700,000 home would cost you a whopping $5,400 a month. So essentially a $900 difference in payment for the exact same amount of home. But here's the thing. It isn't the exact same amount of home either. Despite prices of homes cooling off over the last few months, we're starting to see an increase of demand. For whatever reason, more and more buyers have been accustomed to these higher rates, and it seems that demand of homes is still going to remain strong. So in reality, that same $700,000 home is probably going for about $750,000 or even $800,000. To really put into perspective how much affordability has been shot in the foot by these higher interest rates, let's take that same $700,000 home with a payment of about $4,500 a month. So in order to stay at that same $4,500 a month, with these higher interest rates at 7%, that would mean you would have to find a home priced at $590,000, not $700,000, to stay at that same payment. So essentially, with a 2% increase in interest rate, that means a whopping 16% decrease in buying power. So if you are considering buying a home right now, realize right now the interest rate market is incredibly volatile. And what you get it pre-approved for right now might not be the exact same rate, payment, or purchase price as what you actually get into whenever you buy a home. One of the great solutions that I'm offering a lot of my clients right now is what's called a lock and shop option. This allows you to pay an upfront but refundable fee to lock in your interest rate right now for 90 to 180 days, allowing you to shop for a home without having to worry about rates getting any worse than what you locked into. This also gives you the flexibility that if rates do end up getting lower by the time you find a house, you can actually float that rate down at a small cost. It's not exactly the most perfect solution, but it does help you avoid a lot of those headaches that you might find when looking at homes and worrying about where your payment's going to go. But wait, it's about the middle of the year, so what happened to all those experts saying that you could expect mortgage rates to drop like a rock by May 10th? Well, the reality is most of those experts were looking at only one data point, which was inflation. And it is true, inflation has dropped like a rock this year. The Consumer Price Index, or CPI, which is what we use to measure inflation, was as high as 9% last year. And since then, as of May, we're at about 4.9% year over year. This was the number that a lot of people were pointing to as a big indicator that once we got under that 5% mark, we should see interest rates drop pretty significantly. I know there were a lot of mortgage lenders, even myself, expecting rates to be under 6% by now. But here's the reality. Mortgage rates aren't just driven by one singular data point at a time. While yes, the biggest driver for mortgage rates over the last year has definitely been inflation, we've actually seen some other big major economic events happening in the last few months that have kept interest rates a little sticky, even though inflation has come down in a big way. The biggest and most recent ones obviously have been those massive bank failures. I'm talking about SVB and First Republic Bank, just to name a few. These were obviously some unintended consequences of the Fed getting very aggressive with raising their interest rates, causing a lot of the investments of these regional banks to go a little bit sour. And as you can imagine, any amount of bank failures at all would definitely send some pretty big shockwaves throughout the economy. And even though the Fed managed to do a little bit of damage control, they did it with pretty much the same answer that they've had for every other thing they've had to deal with, which was just printing more money. So despite inflation going down, the way that the Fed has responded to these regional bank failures hasn't sparked much confidence that the economy is going to be good in the long term. On top of that, the biggest thing in headline news seems to be the US potentially defaulting on their debt for the first time ever. More and more, it looks like politicians are running out of time to come up with some sort of debt ceiling deal, which could cause a big major government shutdown and potentially mean that the US defaults on its debt for the very first time. And since this would be a first time ever kind of event, obviously interest rates are reacting accordingly and the long-term treasury yields are going up. And whenever you see the 10-year treasury yield going up, often you can see interest rates going up as well. And so that leads us to why, despite the fact of the Fed doing a pretty decent job of combating inflation, we're not seeing interest rates come down in a big way. Now, that being said, when the debt deal eventually gets done, which I'm a believer that it will, albeit probably a little bit too late, we can probably expect inflation to still continue to be the number one driver for interest rates. That being said, this is a stark reminder that no one has a real crystal ball on what's going to happen with interest rates. And so as a result, don't focus so much on your interest rate, but rather whether or not you can comfortably afford your monthly payment and whether or not you have enough cash to make a deal work. Now, one of the biggest things that's continuing to be an issue in this housing market is the brutal lack of inventory. According to the National Association of Realtors, right now in the United States, there's a little over 1 million units for sale. To put it into perspective, typically on average at this time every year, there's usually about 2 to 2.5 million units for sale. So already we're less than half of the annual average. And for those of you who are viewing this worrying about a potential bubble burst like we saw in 2008, for context, before 2008 hit, there were 4 million units for sale. So really, we've got a quarter of the inventory that existed in 2008 and half of what's on the annual average, meaning there simply just isn't enough homes for sale to satisfy this surprising demand of homebuyers. But why is that exactly? Well, the reality is no one wants to give up their really low interest rates that they got over the last couple of years. Even the ones who bought and are sitting on a lot of equity. A recent CoreLogic study showed that 83% of homebuyers in the United States have an interest rate lower than 5%. Moreover than that, 63% of homeowners have a rate between 2 and 4%. So you can imagine a massive chunk of the housing market right now, existing homeowners sitting on rates below 5%, are probably not wanting to jump up to a rate that's 7%, as well as having to buy a home significantly more expensive than what they had bought previously. So now what you're seeing is a massive shift of those home buyers who thought they were buying their starter homes really ending up in their more or less forever or significantly longer term homes. And as a result, home buyers are essentially competing over the same very small pool of homes. So despite home prices cooling off from their recent 2021 highs, what we're now seeing is with this increased demand of home buyers, home prices are actually either plateauing or starting to go back up. Now, that being said, we're in a very interesting situation with these higher interest rates. One of two things is going to happen here. If we start seeing rates creep up well above 7, I'm talking 7.5, 7.75, maybe even 8%, this is probably going to launch the housing market into what I'm thinking is going to be a deep freeze. As you can imagine, for a lot of home buyers, that increase of their rate from 7 to 8% is going to cause a lot of them to not qualify for a home loan anymore, or just simply decide to wait it out and see what happened with rates. And on the selling side, a lot of sellers may reconsider their plans of selling the home too, because they won't be able to qualify for the replacement home either. So we may see a similar situation as we saw in 2022, when rates started picking up pretty rapidly. This caused the market to basically go on pause. Now, alternatively, if we do end up coming up with a pretty decent debt deal and inflation continues to go down, we could say interest rates reverse course pretty strongly. In my beginning of the year prediction video, I predicted that once we got inflation well under 4.5%, which should be about July of this year, we could see interest rates below 6%. So if we do manage to get to that point with inflation and there's not going to be any other extra things going on with the United States economy or the Treasury, we could probably predict that there will be a pretty busy buying season. The question is, will rates below 6% be enough to satisfy those homeowners who are sitting on their equity and consider selling their home and moving up to a 6% as opposed to a 7%. So that's going to be the key thing. Will there be enough supply of homeowners who are willing to sell and get into a slightly higher rate? We're talking, 5.5%, maybe 6% at the worst. Or will they continue to sit on their hands and wait for it to get even lower? And with lower rates, as you can imagine, there's going to be a massive wave of home buyers coming back onto the market because they've been waiting for rates to get below 6 for the longest time. So understanding all these different factors is important to make a great financial decision. But really, you want to understand what are the key things that you need to be thinking about if you you should buy a home this year? Well, there's 3 things that I'm advising all of my clients to make sure that they're making a great financial decision despite how difficult this market is. The first one is pretty obvious. Can you comfortably afford a payment right now? I know there's a lot of people who are saying things like marry the house and date the rate, but as we've seen over the last 12 months, that dating of the rate has become a little bit longer term of a commitment. So despite the fact that most experts agree that we will see a refinance boom in the next 12 months, we might not see rates fall off a cliff. So as a result, somebody getting an interest rate of 7% today may only be able to refinance into a rate of 6.5% in the next few months. So if you cannot comfortably afford your payment right now, I would definitely not suggest buying a home. Additionally, because there's so much economic uncertainty and I've seen a massive number of layoffs, especially for my clients who are in tech or otherwise, I would definitely suggest having at least 6 months of reserves put away for your expenses and obviously your mortgage. You see, not only should you be able to comfortably afford a mortgage payment while you have your current salary, but for example, in a 2-income household, if one of your incomes was to suddenly disappear, do you have 6 months to make it until you find another job? It's something that I know a lot of people don't think about, and frankly, not a lot of people want to talk about, but I think it's a really important piece of data, especially in an economy like this. Now, my third biggest tip for all my clients right now is to make sure that you buy a home that you can actually rent versus selling. I know one of the biggest cop-outs for people who are buying a home is they say, oh, well, if things get bad, I could just sell. But if things get bad within those first few years, you might actually end up losing money instead of making money on your home. You see, the fact is, in those first few years, you're not building a ton of equity right away because mortgages are front-loaded with interest. And if your interest rate is 7%, you're going to be paying a lot of interest versus principal, especially in those first few years. On top of that, selling your home isn't free either. I definitely don't recommend going the forced sale by owner route because you're probably going to end up leaving a ton of money on the table. So more than likely, you're going to have to work with a real estate agent, and you're probably going to have to pay things like title and escrow fees. So in those first few years, if your home's not appreciating enough, you might end up spending more money than you actually make on the sale of your home. And as a result, you should consider renting out your home instead of selling it so you can hold on to that asset as long as possible. Another big consideration to deal with the affordability is maybe buying a home with a few more bedrooms than you actually need. There's nothing wrong with house hacking, and I'm a big believer. So if you're a single person and you only need 1 bedroom, considering buying a 2 or maybe even a 3-bedroom home if you can comfortably afford it, and renting out the other rooms to either friends or family. This will allow you to offset your mortgage payment, provide a place for your friends or your family, while still being able to afford a home and have someone else already pay for it. This is a great way of using a home as a stepping stool, especially if it's already something that's going to be below your budget as a starter home. That way in the future, you've already got an existing tenant in it. You just have to replace yourself, and then you can go off to buy your next property. Now, if you don't manage to check any of these 3 boxes, that's okay. I might be one of the first mortgage lenders on the internet to tell you that it's actually okay to rent if you can't afford to buy. Especially in a market like this, I'm not going to force anyone who I don't think is personally ready to buy a home to do it just so I can make a paycheck. At the end of the day, your finances are yours alone to deal with. And personal finance is personal. I'm a big believer in that. So make sure you're doing your numbers and looking at your budget very closely to see if it'll even make financial sense for you to buy a home. Now, what 2023 has shown us, well, at least shown me about this housing market, is that nobody has a crystal ball. No one can reliably predict what's going to happen next in this economy. So it's very important to make personal choices for yourself based off of what your gut intuition tells you, based on data. What the 2023 housing market has definitely taught me is that nobody has a crystal ball. Despite what a lot of big analysts said about the general direction of mortgage rates, a lot of those predictions simply haven't come true. That's why it's important to focus on your individual finances when making a big buying decision, especially one as big as buying a home. Personally, I think we have a long way to go before we get to a normal, healthy, balanced market. That being said, given the crazy amount of demand that we have right now, despite these higher interest rates, and the fact that we still don't have that much inventory, it's very hard to see a housing crash coming anytime soon. And as a result, if you do decide to buy in this market, you're more than likely going to end up on top in the next couple of years as rates get lower because demand will go up even higher. Now, if you are thinking about buying a home, I've left a link in my description to schedule a one-on-one call with me and my team. We'll help you start building out that home buying plan, whether or not you want to buy this year, next year, or any year after. It's a quick 15 to 20 minute call, but I promise you it's going to be one of the most valuable calls that you will have in your home buying journey. It's completely free and there's no obligation to work with us, but we will connect you with some great professional real estate agents in your area to help you go along your home search. And if you are thinking about buying a home this year or any year really, one of the most important steps is getting pre-approved for a great mortgage. But if you're wondering where to start with getting pre-approved for a home loan, make sure you watch this video next, where I actually cover some of my best tips and tricks over the years to help you get pre-approved for a great loan and make sure that you're actually getting a great deal in the process too. But once again, thank you for watching this video. I hope you learned a lot of new things. If you did, like I said, leave a like button, leave a comment if you have any questions, and consider subscribing if you want to see more content just like this. And if you want to dive more into home buying, make sure you check out my channel channel, I've got a great playlist with some of my best home buying tips and tricks, as well as some other market updates. But that's all I've got for this video. I'll see you in this video next. Bye.